Good morning, all. Good morning to this public hearing, this historic public hearing that we're doing. When we think of banks, we somehow think of some stodgy place that is only concerned about the bottom line, dollars and cents. When we think of the environment, we think of young people doing wonderful things, and never the twain will meet. Well, my friends, in New York State on this morning, we're actually meeting. And we're going to try to figure out how do the best goal that is ever saving the planet. Wouldn't that be different? Thank you for attending this public hearing on banking and climate risk, jointly sponsored by the Senate Banks Committee, Senate Finance Committee, and the Senate Environmental uh, Conversation Committee, Conservation. Oh, it must be Tuesday. I represent the lower ninth ward of New York City. I represent the Rockaways and other parts. Now, the lower ninth ward comes out of New Orleans and is famous for the flooding area, but I represent that part of New York City. And Superstorm Sandy caused tremendous damage to my district. Climate change made Superstorm Sandy more severe than ever expected. I look forward to hearing expert testimony on how government, banking, and public interest groups, and of course, local residents view the risk of climate change. I will stop and allow my co-chair, Senator Todd Kaminsky, to have a few words. Thank you for having us here, Todd.
Thank you, Senator. Thanks for everybody joining us today for this very important panel. Climate change is a reality that's going to impact every aspect of our society. It's not just an academic conversation. And where capital is going to be deployed, how businesses are going to deal with climate change risks, and how money is going to flow into opportunities to both mitigate that risk and to decarbonize is going to be extremely important in the coming decades, more important than ever, and will grow exponentially. So hearing from folks in our financial community today about this issue is incredibly important. We have to be more aggressive, more forward-thinking, and certainly prepared. So welcome everyone today, and I look forward to hear what you have to say.
Thank you. I will be remiss if I did not allow my fellow senators, Steck and Mays, to take a 30-second saying what you wish in 30 seconds. Senator Steck, how about you?
Thanks, Chairman. It's good to be here with everyone, and I appreciate this topic, its importance, and look forward to hearing what everyone has to say today. But thank you very much for pulling this together.
You're more than welcome, sir. Senator May.
Yeah, thank you, Mr. Chairman. And I want to say how important this is. We're watching right now the power of the financial sector potentially to create geopolitical change in Ukraine. And I think the power of the financial sector to be a really important ally in addressing the climate crisis is something we have to make sure that we're activating to the fullest. So I applaud you for having this hearing and look forward to the testimony.
You're more than welcome. We have two distinguished witnesses that we will hear from. Dina, how do you pronounce your last name?
It's Moore.
I'm sorry?
Moore.
Moore. We have two distinguished panelists, and Dina, of course, will be the first one. She is the senior vice president, the vice president of the supervisory policy and strategy function of the supervision group. And of all of that is the Federal Reserve, my friends, the Federal Reserve Bank of New York. And when the Federal Reserve weighs in on a situation, you know that it is serious. Without further ado, we will hear from you, Ms. Moore. You are on. We're having fun this morning. That was a cue for you, Dina. And I was going to bring you, either you have frozen or I have done. Were you frozen, Dina?
Hopefully I'm back. I'm sorry.
You are absolutely back. It's Tuesday.
This is the new
don't
world
worry.
we're living in. Living in the
is.
Zoom world these days.
Please, would you be kind enough?
Thank you so much. Thank you. Chair Sanders, Ranking Member Borello, Chair Kruger, Ranking Member O'Mara, Chair Kaminsky, Ranking Member Steck, and Senator May, and members of the committees. Thank you for this opportunity to testify about how the Federal Reserve Bank of New York is addressing potential climate-related financial risks to the banking industry. It is a privilege to testify alongside Nina Chen from the New York State Department of Financial Services. Nina is an outstanding partner in prudential supervision. Please permit me to thank Nina and her colleagues publicly for their collaboration. Before continuing, I am required to state that any opinions I express on my own, not necessarily those of the New York Fed, where I work, or any part of the Federal Reserve System. The focus of my testimony today will be how climate-related financial risks factor into the supervision of financial institutions, which the New York Fed performs under authority delegated by the Board of Governors of the Federal Reserve System. I would like to emphasize that any policy decisions regarding supervision, including about how the Federal Reserve will address climate-related risks, ultimately will be made by policymakers at the board. The Federal Reserve supervises financial institutions to ensure they operate safely. In addition, the Federal Reserve monitors the financial system as a whole by identifying and analyzing potential risks to financial institutions and the broader financial system and the economy. And once material risks and vulnerabilities are identified, the Federal Reserve works to ensure that supervised financial institutions and the financial system are resilient to those risks. Climate-related financial risks generally fall into two categories: physical risks and transition risks. Physical risks are the direct consequences of more frequent instances of severe weather and other climate shifts. For example, the losses from the physical manifestations of climate change could impact homeowners' ability or willingness to continue making mortgage payments to their lenders or tax payments to state and local governments, which could then result in losses for bank lenders and municipal bondholders. Transition risks are the consequences, both direct and indirect, of changes necessary to limit climate change. Transition risk can arise from changes in consumer and investor preferences, new technology, or changes in governing law. For example, if consumers develop preferences for green products and a company fails to foresee this change in demand, the company may suffer financially. This in turn could create financial or market risk for supervised financial institutions that lend to that company or hold or underwrite its securities. Evaluating how these physical and transition risks translate into what we consider traditional banking risks, such as credit, market, liquidity, and operational risks, is not an easy task. Climate change happens over a long time horizon. We lack historical data on which to build analytical models. And we work in a global economy which amplifies these complexities many times over. That said, both physical and transition risks have potential to affect communities and industries across New York State, including the financial sector. A recent review of literature by New York Fed economists informs us that the impact of physical and transition risks may be uneven across location, income, race, and age. Moreover, measures that individuals and governments take to adapt to climate change could increase inequality. These risks to local industries and communities, in short, to New York's economy, can also translate into risks for banks. The board has organized several committees in coordination with colleagues across the Federal Reserve System to assess and monitor the financial risks around climate change. Before concluding, I would like to offer two observations. First, the Federal Reserve's work on climate change is important, but limited to our existing mandates, particularly those related to the supervision and regulation of financial institutions and the stability of the broader financial system. Second, While economic changes as a result of changing consumer and investor preferences, technological developments, and governmental policies present potential risks for the financial sector, they also present opportunities. For example, financial institutions are responding to investor demand for environmental, social, and governance considerations, more commonly known as ESG investments. There are also opportunities for collaboration between private and official sectors, which will promote a better informed response to climate change. Today's hearing is a good example of that. Again, thank you for the invitation to testify. I would be happy to answer any questions.
Indeed, at the appropriate moment, we shall. But I would be remiss if I did, you can reset the clock. I would be remiss if I did not say that we've been joined by Dr. Chen, who was appointed as the Executive Deputy Superintendent of the Climate Division of New York State Department of Financial Services. This is a first, my friends. I believe it's the first I think it's the first in the nation. Certainly it's the first in New York. And I have seen her nod. So it's the first in the nation. That speaks well of the DFS, and it speaks to the directorship of course, the new superintendent, Adrienne Harris, to appoint such a person. We thank you. In fact, we thank both of you for testifying today. Without further ado, Dr. Chen, would you be kind enough to testify?
Thank you very much. Good morning, Chair Sanders, Chair Kaminsky, Chair Kruger, and to the esteemed members of the Bank Finance and Environmental Conservation Committee. I'm Dr. Yue Nina Chen, the Executive Deputy Superintendent of the Climate Division at the New York State Department of Financial Services. I'm truly honored to appear before you today on behalf of DFS. I also want to express my appreciation to the New York Federal Reserve Bank and the Federal Reserve Board for their close collaboration. Mr. Dina Mara and her colleagues have been fantastic partners for our work. DFS regulates approximately 3,000 banking, insurance, and other financial institutions with assets totaling more than $9 trillion, including over 1,200 depository and non-depository financial service providers and nearly 1,800 insurance companies. DFS fosters a safe and a sound financial service market while providing important consumer protection. As discussed in the previous remarks by Ms. Marr, climate change poses wide-ranging and material risks to the financial industry, consisting of both physical and transitional risks. These can affect banks directly, as well as indirectly through their customers and the business environment in which they operate. While climate change impacts everyone, economically vulnerable communities, often low income and the communities of color, are particularly threatened with respect to physical devastation, such as flooding. In hard-hit communities, climate change is expected to undermine economic output, reduce already limited household income and wealth, and diminish access to capital. Disadvantaged communities also have fewer resources to recover from climate disasters. With that background in mind, I will focus my testimony today on the actions DFS has taken to address the significant risks affecting the finance sector within our statutory mandate and in support of our mission. Over the past several years, DFS has demonstrated its proactive leadership in addressing climate issues through its groundbreaking actions, the issuance of industry letters and supervisory guidance, educational effort, and outreach to the industry. In October 2020, DFS issued the industry letter on climate change and financial risks, which established a set of high-level expectations for banks to start integrating the financial risks from climate change into their corporate governance, business strategies, and the risk management, and to start developing their approach to climate-related financial disclosure. DFS was the first US financial regulator to do so. Another first was a similar circular letter DFS issued to New York regulated insurers in September 2020. We partnered with New York Department of Environmental Conservation and the New York State Energy Research and Development Authority to host a series of webinars on what the likely physical risks are in New York and the Northeast, and on clean energy financing opportunities for our community and the regional banks. We also engaged with individual banks, industry roundtables, and the trade associations. In February 2021, DFS issued an industry letter on CRA consideration for activities that contribute to climate mitigation and adaptation, to encourage banks subject to the New York Community Reinvestment Act to support climate resiliency of low and moderate income and underserved communities in New York, while qualifying for CRA credits under the New York law. In addition, DFS has actively participated in key national and international networks of banking and insurance supervisors focused on climate risk. DFS was the first US financial regulator to join the International Network for Greening the Financial System, a network of central banks and banking supervisors working on climate and sustainability related issues. DFS has also developed a toolkit on stakeholder engagement on climate risks for District 1 of the Conference of State Banking Supervisors. I also serve as the vice chair of the Climate Risk Steering Group at the International Association of Insurance Supervisors. DFS high priority focus on climate risk and bold actions has accelerated under Superintendent Harris' direction. In her forward-leaning agenda, Superintendent Harris has created the nation's first climate division at the US financial regulator, which elevates the importance of New York State's pioneering climate work and further enhances DFS' ability to tackle these issues proactively. I was honored to have been named as the Executive Deputy Superintendent of this essential division to continue to support New York State's trailblazing initiatives in climate. Under Superintendent Harris' leadership, DFS issued the final guidance for New York domestic insurers on managing the financial risk from climate change, detailing its expectations for insurers' management of climate-related financial risks. We're pleased to have accomplished this task last November, and even more proud to know that this achievement was another first in the nation. Building on this existing momentum and the principles set forth in the banking industry letter on climate change and financial risks, DFS is currently working on a supervisory guidance for the banking sector, which will be issued initially in a proposed form for public feedback. We welcome the inputs of stakeholders such as you and your colleagues in the legislature. In addition to implementing our current initiatives, the division structure has increased DFS capacity to continue our work with the financial industry to develop practical solutions, as well as to coordinate with other regulators. This is important for our regulated industries as they value consistency across jurisdictions. To best position DFS to work on additional critical objectives, including enhancing communities' resilience to climate change and to support sustainable finance in New York. We know it's important to have the most innovative thinker on our team. We're taking all the necessary steps to attract the best of the best in building the division's talent. Thank you very much for the opportunity to testify before you today. As we continue to advance New York's leadership on climate, we look forward to engaging with you and your colleagues in the legislature. Now I'm happy to take your questions.
Indeed. Thank you for your testimony, and you can stop the clock. I have a couple of questions, but I'm going to yield to my colleagues, starting with Senator Kaminsky, going to Senator May after that. Senator Kaminsky, sir.
Thanks, Chair Sanders. Thank you so much to Dr. Chen and to Ms. Marr for your testimony today. I'm the chair of the Environment Committee, and I got to author the CLCPA, which really is going to make us the first in the nation in transitioning to a green economy. And I appreciate, Ms. Marr, you talking about opportunities. I think if we keep looking at these things as risks, it really fails to show a lot of the upside that I think the CLCPA embodies, which is being on the ground floor of a green economy and kind of being where the money's going to go instead of trying to chase it, which I think a lot of other states and countries are going to end up doing when we show them what we're capable of achieving. What I'd like to push both the Fed and DFS to do is to demand more from your partners and certainly the businesses you regulate to at least begin to have to think about and be transparent about what ESG actions they're taking to be more climate resilient. We know every day that more activist investors, more lenders, certainly institutional investors are demanding more from financial institutions and companies in which they're investing. Boards are demanding more in terms of what actions are being taken by those companies to ensure that they're less subject to climate risk, but also doing something to help us reach the goals in the Paris Accords and have a commitment to ESG principles. I certainly think it would behoove both of your institutions to also start demanding those same things. And it doesn't have to be you must reach a given goal, but it certainly can be what the SEC is considering now, which is what measures are you taking to deal with climate exposure? What business actions are you taking that's material, such that you believe that let's say, for example, the E in ESG is something you're considering in your decision-making processes. I think it would be great if New York led the way by having its banks, its financial institutions, its lenders have to tell the public what ESG actions they're taking or not taking. And I think it would help them view each transaction through that prism. Can I get your thoughts on that idea, please?
Thank you, Senator. So 2 points. First, just to reinforce that the Federal Reserve's mandate is to ensure the safety and soundness of banks and the stability of the financial system. And we do not regulate banks' business models or specific lending decisions. Additionally, the New York Fed conducts supervision under delegated authority from the Board of Governors in Washington. The decision to make policy changes consistent within those mandates rests with them. I'd also like to just comment with regards to climate disclosures. So the Federal Reserve and other financial regulators participate in the Financial Stability Oversight Council, or FSOC, which is chaired by Secretary Yellen of the Treasury. The FSOC recently recommended that its members review their existing public disclosure requirements and consider updating them to promote the consistency, comparability, and usefulness of the information on climate-related risks consistent with their mandates and authorities. Work on climate-related disclosures is ongoing, and the application of any data collected from them that could help the financial institutions and their supervisors understand climate-related risks in the system.
I appreciate that, Ms. Maher. The only thing I'll say, and I guess speaking to the board of directors, I think they're dipping their toe into this important body of water, but I think they should be quicker to act and more exacting in what they are requiring, because those very things that they're looking for in terms of transparency are things that investors want to know. And I think eventually we'll go to the heart of what it means to run a stable financial system, because it'll need to take into account climate change one way or the other. So thank you for that. Sorry, Dr. Chen.
Yeah, thank you very much for your question, Senator Kaminsky. And we also very much appreciate your leadership on the environmental conservation front. Totally agree that public disclosure is very important to ensure the market have can properly assess institutions' risk exposure and have more confidence in the market. So if you look at the insurance guidance that we issued the last year, we have a whole section dedicated to public disclosure on this issue. So I encourage you and your colleagues to review that, and always happy to engage with you and your office to discuss further.
Okay. Thank you, Senator Sanders.
Thank you, Chair Kaminsky. Senator May.
Yes, thank you. And I have a question for Dr. Chen. So Senator Krueger has a bill to end the practice of subsidizing fossil fuel use in the state with taxpayer dollars. And I'm wondering if there is legislative action we can take that would help to tilt the playing field toward positive investments. For example, make it easier for people to get loans for things like weatherization or net zero building, or some of the farming practices that we advocate in terms of soil health and resiliency, and carbon sequestration. So is that something that is even possible at the legislative level? And how can we be helpful in steering investments in those directions?
Yeah, thank you very much for your question, and Senator May. So right now, DFS does not have the authority to tell what banks and insurers should invest or not invest, or who they should lend to or not lend to. At the same time, we very much recognize that climate change is not just a risk, it also brings tremendous opportunities. That's why we have hosted webinars to educate our community and regional banks on what are these climate-related opportunities. And we also issued the CRA letter in February to encourage banks subject to the New York CRA to support communities' resilience to build both climate mitigation and adaptation methods while qualifying for CRA credits. And we're always ready to engage with you and your office to discuss this further.
Okay, thank you very much. Thank you, Mr. Chair.
Thank you. Senator Steck, I'll even yield to you if you wish. All right, thank you. Let's go with the Federal Reserve first. Again, we're really pleased in New York State to have a very activist Federal Reserve, activist in the sense of community cooperation. That's what I'm speaking of. So we're pleased and to know that there's a growing relationship. Let's speak for a moment of how does the Federal Reserve incentivize or penalize banks in terms of climate change. How do you envision this, Ms. Maher?
Thank you, Senator. I'd like to reemphasize that the Federal Reserve does not make policy decisions in terms of how banks should direct their lending decisions, and that our mandates are limited to the safety and soundness and financial stability of the financial system. Okay. Our role is to understand what types of material risks banks are subject to and ensure that they are resilient to those risks in the face of any material issues. And so the role of bank supervision is to make sure that banks have identified, measured, monitored any material risks, including those potentially from climate change. We're continuing to do analytical work and engage with a wide range of stakeholders to better understand the potential implications of climate change for our supervised institutions.
Well, climate change is such that a wide range of organizations that one would not think of are moving in this direction, including the Department of Defense, which put out its own study on climate change as a danger to the national existence and national economy. Does the Federal Reserve, how do you put out and spread the best practices? How do you ensure that the banks understand, A, that there's a problem and here are the best practices around the problem?
So, thank you, Senator. The Federal Reserve has not made any policy-related decisions, and right now we're still focused on analysis and engagement to understand these risks. And as I noted earlier, the New York Fed conducts supervision under delegated authority from the Board of Governors in Washington, and any policy decisions will be within our mandates, will rest with them.
If I could encourage the Federal Reserve to come up with best practices, that in your journey you had you had the oversight and seeing so many good ideas. I'm not saying everything coming out of the banking industry is bad. There are many good ideas, and that someone has to have the ability to share these practices with others, and I would encourage the Federal Reserve to see that may be a useful thing to do. I understand that at this moment you're saying that is not within your scope. Let me encourage you under there. Then I'll speak to Dr. Chin, who may feel it's in her scope. With the same question on best practices, Dr. Chin, when you see good practices, how do we make sure everyone knows this?
Thank you very much, Senator Sanders, for this question. We definitely see the value of good practices helping the whole industry move forward. So that's why we put together a report last year based on the analysis of the responses to climate risk disclosure survey conducted by the National Association of Insurance Commissioners. So we require New York insurers with countrywide premium larger than 100 million to respond to a survey, and there's a wealth of information there. So based on their responses, we put together this report, which include a lot of examples of good practices that can help help all our insurers to move this work forward.
Okay, on behalf of my colleagues, if you would be kind enough to send us all your industry letters and best practices and any other worthy document, we would appreciate it. Let's go into the very nitty gritty of the thing of climate change itself. I will speak of my own community. I understand it the best. Some of the areas in my community, which is a beachfront community, it's almost impossible to protect them. How do we encourage banks to, and government, since we are government, why let me change my question. Why don't we just buy these homes from people who are in areas that is almost impossible to protect, meaning that we'll have to be hitting FEMA over and over and over, when it may be a better banking move to just buy them out? Dr. Chin, that's yours.
Thank you very much for your question, Senator Sanders. I definitely recognize the impact of climate change on our communities. The buyout program, unfortunately, is outside of my purview.
Okay. What are you doing on the issues of climate change and inequality? How does DFS ensure that climate change does not lead to more inequality?
Yeah, thank you very much for this question, Senator Sanders. As I stated earlier, climate change, while it impacts everyone, it disproportionately impacts communities of color and the low and moderate income communities. So that's something that we emphasize in all our communications with the industry. You can see that in our industry letters and circular letters, as well as the insurance guidance that we issued. That's also why we issued the CRA letter last February to encourage banks subject to a New York CRA to support community resilience as and qualify for the CRA credits. And we're always ready to, happy to engage with you and your office to figure out what other practical solutions could be.
Let me praise DFS for the allowing climate change and community resilience to be looked at in terms of the CRA, a very smart use of the state CRA. Is it also federal, or is it just New York State doing this?
To my knowledge, so New York has New York CRA laws, so I can only speak to what's happening in New York.
Mhm. Very smart. I hope that the other ones are doing it. To our panelists, if there's any last word that you want to have, this is a moment. And then first, in fact, let me find out if my has Senator Kaminsky. Chair, do you have any further questions or any other senators?
No, thank you. I'll just end with a final statement that I'm hoping that both organizations, in demanding their regular processes from those they work with, those seeking charters, licenses, lending, et cetera, more is demanded of them in terms of what their ESG commitment is and what their current practices are. And I appreciate you both being here today.
If there's no senator who wants to speak, then I want to thank this panel. Thank you very much for presenting, and thank you for the history that you're making as we battle to save our country, save this planet, and we do it through the banking system also. Thank you very much.
Thank you very
Thank you
much.
so much for the opportunity to be here today.
Thank you.
We're delighted that you were. Then I dismiss this panel. Thank you very much. And we'll bring up our next panel. And I will allow Ivan to introduce our next panel. Welcome to the world of Zoom, where we are learning our technology and getting it together. I believe that our next panel is ready.
Yes, our next panelist is Robert Engel, and then he'll be followed by Bob Letterman.
A little bit more about Mr. Engel, please. We're not hearing you, sir. Then let me do some. Mr. Engel has done what I'm trying to do in my life. I'm trying to get a Nobel Prize. I just have not figured out anything worth speaking about, sir. And you have certainly spoken of many different things. We're really happy to have you, and we congratulate you on your winning the Nobel Prize. And to speak on this issue is important too. So, Mr. Engel, we will let you begin. And why don't you take just 10 seconds to speak to your biography, sir.
Well, thank you very much, Senator Sanders and members of the committee. Thank you for the opportunity to testify here today. Yes, the Nobel Prize is an amazing institution, and it does change your life. And I'm hoping that the work that I continue to do will be useful in lots of ways in improving our world. I am the Michael Armelino Professor Emeritus at New York University Stern School of Business, and I'm the co-director of the Volatility and Risk Institute at NYU, which studies climate risk, cyber risk, geopolitical, pandemic, and financial risks to the global economy. The Nobel Prize was awarded in 2003, and it was for developing a statistical model, which is called ARCH, which can be used to measure and analyze financial risks. So it's a very appropriate continuation of this work that I do in modeling risks that affect us all. I am testifying today about the risk of climate change to our banking sector in particular, and to New York, US, and global economies more generally. Climate change is no longer a distant threat. Its effects are already visible all around us, and there's every reason to think they will become more extreme. So all of us must develop plans to adapt to and to mitigate these risks now. Typically, we try to assess two types of climate-related risks, as you heard this morning, and as we're well aware of: physical risks, which result from especially severe heat waves, drought, wildfires, floods, sea level rise, storms, and hurricanes; and transition risks, which result from our human efforts to reduce or mitigate climate change by reducing emissions of greenhouse gases, such as CO2 and methane. The economic financial costs of physical risks are well publicized, but those in the future from transition risks are also important. The policy changes needed to make the transition from current carbon-dependent economy to a decarbonized one will take years, will be expensive, disruptive, and it will create winners and losers. Companies, households, and governments may be exposed materially to both physical and transition risks. The pricing and performance of the stocks, bonds, and loans of exposed companies are sensitive to these risks, and those more exposed to these risks will have to offer investors higher returns to make them interested in assuming those risks. Households may face losses in their property and their financial assets, and the cost of insuring property against these risks is rising rapidly and may become unaffordable or ultimately unavailable. And governments will face losses to critical infrastructure and doubtless will be called on for resources to manage and underwrite future damages. Banks may make loans to companies and households facing climate risks. Such loans face more than average risk, but potentially higher returns. However, if the risks are concentrated within the loan portfolio, the bank may be taking unacceptable risks that threaten its safety and soundness. Likewise, the risks to insurers for their portfolios may be excessive. This is why it's completely appropriate that the New York Department of Financial Services has issued guidance on these risks for banking and insurance companies. And it is also appropriate that the federal financial regulators are calling attention to similar risks for other parts of the financial system. To be sure, it may be that many physical risks don't excessively threaten banks if their loan portfolios are geographically diversified. However, transition risks from decarbonization policies such as carbon taxes or regulatory mandates would have a broad impact. And within a bank portfolio, this correlation could raise safety and soundness concerns. Moreover, across banks, insurers, mortgage underwriters, and securities dealers, the same correlations could threaten the whole financial system. As we implement policies to mitigate physical climate risks and to decarbonize our economy, we must ensure that financial stability is not jeopardized. This is the discussion that we heard this morning. This is the target of the Federal Reserve, and it seems like a very appropriate target. Following the great financial crisis, financial firms and regulators routinely employ stress tests in order to assess the resilience of financial firms and the financial system, and ultimately the economy itself. Stress tests examine the resilience of these sectors to adverse scenarios. And bank supervisors use these tools to prescribe capital ratios for the firms they supervise. It's natural to use these tools now to consider adverse climate scenarios. However, as regulators and supervisors have made abundantly clear, we are not there yet. There is a global effort to develop tools appropriate to this task. At the Volatility and Risk Institute, the VRI, we have developed research designed to assess these risks for banks. And there is a paper attached to this references in this report by Hae-Yeon Young, Dick Berner, and myself. We examine the sensitivity of market performance of each bank to changes in the performance of the fossil energy sector, which we associate with transition risk. We call this sensitivity a climate beta. It reflects the market's view of how exposed each bank is to this measure of transition risk. We find from regulatory filings on the loan composition of the assets of these banks that banks with a higher proportion of loans to the oil and gas sector have higher climate betas. This exposure measure can be estimated at low cost and high frequency to monitor the climate risk of individual banks and the banking sector as a whole. We find that the climate betas are rising, that we estimate, in 2019 and 2020 for US banks and for banks around the world. The implication is that bank valuations have recently become more sensitive to climate risk. Why has this happened? Perhaps this is because the pandemic has many features of transition risk. That is, less demand for transportation, substituting video contacts like this for actual in-person meetings. Perhaps it's because we have become more aware of climate risks today and the market is valuing these more highly. Or maybe it's because these banks have actually increased their loans to climate risky borrowers. We don't know the answers to what the causes are yet, but this is part of our ongoing research. These preliminary estimates of climate sensitivity can be used to assess the resilience through its capital adequacy of each bank under a scenario involving transition stress. A key finding is that a 50% drop in the collective share prices of fossil fuel companies over a 6-month forward-looking period could significantly impair the capital adequacy of the 10 largest US banking firms, some of which are headquartered in New York. We estimate that the impact on these firms' capital in this scenario would reach 70 to 90 billion at the end of 2020. We have made this research public in order to share it with others, to get feedback and to improve it. The VRI maintains a public website at VLab, which includes many measures of climate and other risks. Soon, the bank exposure and capital shortfall measures I've just discussed here will be available there. These will be updated weekly and will make it easier for regulators and risk managers to monitor the importance of this risk. We hope this information will be a useful supplement to the kinds of disclosures that banks and other financial firms will be making to the New York DFS and to federal regulators. And to you, the committee, as you decide on appropriate policies to address these risks. Thank you again for the opportunity to speak with you today, and I will be happy to take your questions. Thank you.
Because Dr. Ingalls has to leave, we will go into questions immediately. I will yield to Chair Kaminsky.
Thanks so much. Thank you so much for that very important testimony. That information you're giving is probably little known to the public, but I think extremely concerning, considering the risks that are attendant on our main financial institutions. So I have a wide-ranging question for you, and it's a little prescriptive, probably a little bit out of the ordinary of what you're asking, but what should we as New York State legislators do in light of the information you're giving? Clearly, we have pushed very hard to transition our state's energy economy. I've been working on that for a while, but that's different than what we could do to encourage the private sector or make the private sector have to be more transparent and more conscientious of climate change. We just had two important institutions on here. Should we be pushing them to do more? Should we be putting in statute more direct regulations on financial institutions that are under our authority in New York? Should we be pushing our federal colleagues to do more? What do we have to do in light of what we know and in light of the risks that you highlighted? And thank you for your work on this and for participating today.
Senator Kaminsky, thank you for your question. It is a wide-ranging question. It seems that, well, first of all, the most important thing that government as a whole can do, I believe, is to put a price on carbon so that firms are actually charged for their emissions. New York is part of the RGGI system, which I think it's important that you support this system and that it's perhaps expanded to other regions of the country if that's possible. And at the moment, the price of emissions is very low, and I can understand why that's true. But in many places around the world, especially in Europe, these emission certificates are rising in price very rapidly.
And California has a low carbon fuel standard that I'd like to see implemented in New York. So, you know, by the time we get from where we are now to electrification, we at least start encouraging companies to either pay or use cleaner fuels, which is not the entire thing of what you're saying, but I think an important part of
it. That's right. This is a regulatory approach as opposed to a pricing approach, and I think that both are likely to be useful in this process. I also think that investors are an important engine for making this happen, and if we are unable to really effectively price carbon, it's important for investors to know what the performance from an emissions point of view is for the companies that they invest in. And we have seen these voluntary markets in voluntary approaches to companies claiming net zero targets and so forth.
offsets and whatnot. Yeah.
And offsets are an important part of that. And I think that there is clear room for a new policy on how to deal with offsets, how to certify them, how to make sure that we are appropriately giving credit to good offsets relative to weak ones. And I think that the use of these kinds of information sets for investors is very complicated. They don't really know how to treat the net zero commitments. They don't know whether they are being honored by and are effective for these companies. And so I would support some of the disclosure ideas that you mentioned to the previous speakers.
Okay, this is all very helpful.
Thank you. Senator May, if you wanted to. Sir, so I have several questions. I'll boil it down to, well, the first one is you mentioned your stress test, sir. Has it been accepted by the industry? Is it a standard or the standard?
No, it is by no means the standard. This is research. It is similar to stress tests we have done to financial companies around the world following the financial crisis, where we have posted this information on the internet. Regulators look at it, use it, but they don't regulate based on this. This is additional information for them. It's also information for investors. And we are hoping that by publicizing these stress tests, we will help the regulatory community and the investment community understand better where the exposures are in the financial sector.
Let's talk more on that, sir, offline at another day.
Okay.
Because maybe that's something that we should do by legislation. If your test, let's talk of it and talk to what we can do that way. My final question to you, which will be raised to our next speaker, is why are financial institutions moving so slowly with this threat, sir?
I think it's a tough sell for financial institutions. Financial institutions know how to choose investments to maximize returns and profits. So they have a hard time deciding whether to forego some profits in order to target their investments toward more public goals. This is a problem for investors. It's a problem for financial institutions. This is why the first step should be, according to many people, and I think you'll find the next speaker is very articulate on this question, is to price carbon so that companies that are making the most profits are the companies that are controlling their emissions.
Well, we understood that you had a time limitation, sir, and let the record show that we kept within your time limitation. So the next time I invite you back, I hope that you'll be there, and please give me some tips so that I too can get a Nobel Peace Prize, sir. I've been trying, I just have not found anything worthy enough. yet.
Well, I think you're working in the right area.
If I solve this one, I demand all of them. Well, I thank you very much, sir.
Thank
And because we have a future Nobel Prize winner with Mr. Litterman, who is about to speak. And Mr. Litterman, of course, comes from the Capos Capital, is a New York City-based global macro firm. And he is going to, of course, explain what that is, since I deal with micro capital, sir, and I have not reached macro capital. And then he has to explain what this has to do with the issue of banking and climate change. Dr. Litterman, please continue.
Yeah, Senator Sanders, thank you so much for inviting me here. And it's my pleasure to talk about climate risk in the financial system. My name is Bob Litterman. I am a financial economist, and I've spent the past 10 years focusing on the cost of inaction on climate change. In 2020, I chaired the subcommittee of the Commodity Futures Trading Commission, which published a groundbreaking report called Managing Climate Risk in the
It is Tuesday and you froze for a moment, sir.
In particular, Dr. Engel, and I actually am an advisor to his Volatility and Risk Institute at NYU. And also, I'd like to acknowledge the great work of Dr. Chen at the Department of Financial Services and her work leading in climate risk in New York State. As you know, climate change poses serious systemic risks to our economy and the safety and soundness of the financial system. I chaired the CFTC's 34-member subcommittee, which produced the first federal government report highlighting the systemic risk climate has on our economy. This report was significant not only for highlighting the risks that climate change poses to the financial system, financial markets. Those stakeholders included the major banks, insurers, investors, asset owners, non-financial corporations, including oil and gas companies, academics, and environmental organizations. And they all endorsed the findings of the report. And by the way, the first and most important recommendation of that report is that we urgently need a price on carbon. So I totally agree with Dr. Engel. That is really the number one thing that we need to do. And since then, there have been numerous supporting statements and actions that have been taken by a range of federal financial regulators responding to the risk climate has on our society generally and on our financial institutions, including banks specifically. The Federal Reserve, the Comptroller of the Currency, the US Department of Treasury, the Financial Stability Oversight Council, and many more all agree that climate change is a real and growing financial risk to our financial system. The risks of climate change are not a concern for the future. The climate has already changed, not only the average temperature, but more importantly, the probability of extreme events along many dimensions. The present climate is not the same as we have experienced in the past. Assessments of the physical risk of extreme weather must recognize this reality. Any assessment of hazards affected by climate change must be updated to reflect the current and future risk. Rare catastrophic historical events are now, in many cases, much more likely to occur today than they have been in the past, and such hazards will increase in the future. These events, such as powerful hurricanes, are often made worse by other impacts of climate change, such as sea level rise. The analysis of climate change is both complex and extremely local. Governments cannot, for example, depend on historical experience to set building standards, to design infrastructure, and to regulate insurance markets. Yet each municipality will face different hazards and will need to respond locally. The US banking sector is likely far more exposed to transition and physical risks than most banks and regulators have yet to account for. The interconnectedness of our financial systems means stress can spread quickly, amplifying and transmitting disruption throughout the economy. It's widely understood that banks are exposed to both those physical risks associated with asset damage and the transition risks caused by changes in valuations associated with the shift away from fossil fuels. The 2020 Ceres, the nonprofit organization whose board I serve on.
If you'll stop the clock, why don't we give the doctor another 3 minutes for his freezing? Doctor, would you be kind enough to state that last paragraph again, sir?
Yes, I'll try, sure. Can you hear me now?
Yes, sir.
Okay. In 2020, Ceres, the nonprofit organization whose board I serve, produced a report financing a net zero economy, and that report is available. Power that are receiving the most scrutiny today. When looking only at oil and gas, electric power and transportation, banks are unprepared for a climate-related transition shock that might cause 3% of losses to their financing portfolio. However, if you look across the entire economy, that would grow to about 20%.
Oh my.
Banks that fail to prepare for the energy transition face far higher risks than what are currently being measured, let alone disclosed. This is even more critical for community banks and credit unions whose loan portfolios are often more exposed due to their geographic and sectoral concentration. A full assessment of a bank's transition risk must take into account a bank's financing of all climate-related sectors, including agriculture, heavy manufacturing, construction, transportation, and importantly, the financial sector itself. The interconnected nature of the financial system means that banks could face climate-related losses from interbank lending and even fire sales of distressed high-carbon assets. When taking into account this more complete assessment of climate-related transition risk, banking sector losses could potentially be over $500 billion, many times higher than current disclosures indicate. The Ceres 2021 report on physical risk to banks revealed that 2/3 of banks' physical risk comes from the indirect economic impacts of climate change, such as supply chain disruptions and lower firms representing the largest source of direct risk. The value at risk to 28 of the largest US banks from physical risk could amount to more than $250 billion annually over time, approaching 10% of their loan portfolio after many years, even if adaptation measures are taken. Ultimately, these physical risks, combined with the potential transition risks, could impact the safety and soundness of certain financial institutions. Banks and the sectors that they finance need to be prepared for an increase in physical climate risk that is already baked into our collective future. Banks must better understand how these risks fit together and how they can generate indirect systemic effects across the economy, disrupting supply chains, national economies, and the lives and livelihoods of individuals. Banks, along with corporations and municipalities, should immediately begin measuring, analyzing, and where exposed, acting to mitigate the physical and transition risks posed by climate change. These include assessing all elements of climate risk and opportunity that may affect their businesses and communities, and disclose those assessments to investors and external stakeholders. These assessments should cover their entire balance sheet, as well as their off-balance sheet sources of revenue, measure the current impact of climate hazards on the value of financial assets, and perform climate scenario analyses for all asset classes in lending, underwriting, and other lines of business. This last point is particularly important. Risk assessment should include scenario analyses based on current climate exposures and forward-looking scenarios. Good risk assessment departs from the idea of most likely scenarios and considers instead many scenarios ranging from feasible to extreme to assess how the climate-related value at risk on a particular portfolio might evolve. The findings of these assessments should be disclosed. As the linchpin of the global economy, financial institutions have an essential role to play in minimizing the worst impacts of climate change. How banks respond to the climate risks that they individually and collectively face is critical. Whether banks act proactively and ambitiously or reactively and modestly is reflective of how they measure and analyze their exposure to climate risk. But the market will only go so far on its own. It is the government's responsibility to establish clear expectations for what constitutes risk management. I hope New York continues in its leadership in a variety of ways, from requiring climate-oriented scenario analysis, training bank examiners to understand climate risk, holding educational events for banks and financial institutions, and conducting research on the different elements of this vital issue. Thank you for your consideration.
Thank you. You can stop the clock. If none of my colleagues wants to question, I have a question.
Sure.
My colleagues. Sir, at least 3 of the senators on the line today come from communities that have been over impacted by climate change. We have felt the devastation. What you're saying is very logical and rational, but there's another way that the financial institutions may take. In terms of insurance, it is almost impossible to get insurance in some areas. Why, in the short period of time, in the medium period of time, what's to prevent the financial institutions from just divesting from large parts of America and just divesting, which will heighten the social and economic inequalities? What is to prevent that, sir? Why wouldn't they? Isn't that a logical, rational position that they can also take?
Well, you raise a very good issue, Senator Sanders, which is that economic agents, whether that's banks or individuals or corporations, they respond to the incentives that they face. And the reality of climate change right now is that it is making certain areas of the country more dangerous, more hazardous. I live in California, and we have become very aware of the increased risk of wildfires. It's just, the amount of area that burns every year is increasing. The impacts on health from the smoke, as well as the fires themselves, is really devastating. And as in California, as in many areas, it's typically the least wealthy folks who can, who are most impacted and who can least afford it. So this is, it's a real problem. And it's a problem that on the East Coast has been observed for a longer period of time in terms of flooding. And what has happened is the federal government has provided subsidized flood insurance to homeowners whose houses are impacted by this increased hazard.
It certainly is Tuesday. So my question until the doctor comes back is, what is government to do and the banking situation, financial institutions to do if we see that the problem is coming up over and over? He mentioned California. I'm sure that the banks are divesting from large parts of California. And I would bet money that those parts have the poorest people there. I guess we will find those things out at another moment as we will struggle to bring our next panel. Good thing I don't believe in conspiracy theories, Senator May. Just when it was getting extra good.
Clearly, you don't believe in Tuesdays either.
Well, I usually I wish that I had that feature when I was going to say something that I would regret. I wish that there was something that would freeze me, but it usually doesn't. And unfortunately for that, I'm seeing that some of our next panelists are being queued up. And Ivan, you will let me know when the next panel is on, and then you can introduce the panel.
The next panel is on right now, and with us right now is Kathy Kantrovitz, who's the president of the New York Bankers Association, and she will be joined by Christina Wiley, who will be, I guess, doing a tag team together. Correct, Kathy?
That's correct. Yes, correct. Good
Okay.
afternoon.
Back together again.
Yes, nice to see you again, Senator.
The pleasure is mine. These are some of the nicest, smartest people in the industry, and I'm very grateful that you're here today. And I will allow you to introduce yourself and to present to us. We'll start with you, Kathy, and then
Thank you,
Kathy.
Senator. The New York Mortgage Bankers Association really appreciates the opportunity to offer comments today at the invitation of Senator Sanders' office. So it's nice to see you again. Short period of time since we last saw each other. But the New York Mortgage Bankers Association is a statewide association that represents the real estate finance industry, which includes banks of all sizes, state and federally chartered credit unions, independent non-depository mortgage bankers, as well as a wide variety of mortgage industry related firms. And the New York MBA encourages its members to engage in sound and ethical business practices, and we strive to inform our members of changes in the laws and regulations affecting the mortgage business. The association helps those engaged in or affected by the mortgage real estate business to be better informed and more knowledgeable, which is why we really appreciate our involvement today. Also, this involves support for a strong economy, a public-private partnership for the production and maintenance of single and multifamily homeownership opportunities, and a strong secondary mortgage market. And as mentioned, I'm joined today by the New York MBA Executive Director, Christina Wiley. And Christina is also going to share some points with you.
Christina, a pleasure.
Good afternoon, Senators. I'm happy to join in the discussion and agree with the general principle that climate-related impacts to risk can be analyzed to assess both current and possible future risk exposure. My comments today will focus on the mortgage banking industry and activities for 1 to 4 family homes. Senator Sanders has often said one of the greatest things is to achieve the American dream of owning a home. My members take this mission to heart while working with New Yorkers throughout the state. For all mortgages, lenders must determine if a property is located in a hazardous flood zone area, and if it is, flood insurance is required. This is a type of risk management strategy. However, outdated flood maps make it difficult to adequately measure flood risk. Dr. Chen has noted that communities of color and disadvantaged communities are at greater risk of experiencing effects of extreme climate events, such as hurricanes and superstorms that produce extensive flooding. Affordable mortgage credit is delivered by my members to the communities that need it most. Today's independent mortgage banker sector is well regulated at the state and federal level and plays a crucial role in the residential mortgage market with sustainable mortgage products through all economic cycles. Affordable housing loan programs include FHA, VA, and USDA loans, all securitized by the federal government. Risks for doing these types of loans is managed at the federal level. If Ginnie Mae requires additional risk management measures, those mandates will be followed by the mortgage bankers providing those loans. HMDA research has shown that mortgage bankers increase their share of originating home loans of owner-occupied properties to minority borrowers in the state, and it's more than doubled since 2008. Government-backed loans, which primarily supports minority home ownership, exceeds independent mortgage bankers' overall share of the mortgage market. In the event of extreme climate events, my loan servicers stand with those affected by hurricanes, wildfires, and other disasters as they recover and rebuild their communities. Servicers provide substantial support and assistance during such times of crisis. Loan servicers follow investor, insurer, state and local guidelines while working with their borrowers, partners, and federal and local authorities to bring relief to homeowners in the immediate aftermath of such disasters. And the loan servicers are committed to helping families, neighborhoods, and communities recover in the months and years that follow. We believe collaboration is key. The Department of Financial Services has acknowledged the need for regulators and supervisors at both the state and federal level to collaborate and evaluate the issues pertaining to climate change, which is an evolving topic with an evolving understanding of the risks. The New York Mortgage Bankers Association supports a principles-based approach, such as that proposed by the Office of the Comptroller and Currency. We urge a principle-based approach and leveraging existing risk management frameworks rather than building out new policies with respect to governance, risk management, and strategic planning. We champion the department's efforts to work with other supervisors and regulators and encourage them to adopt an aligned approach in the management of climate-related financial risk. New York MBA appreciates the opportunity to provide testimony on the management of climate-related financial risks. This is an important and emerging area of risk that warrants attention. Again, we suggest a principles-based approach, one that considers existing strategies and practices and provides flexibility in addressing climate change risk and the evolving assessment of that risk. Thank you.
Thank you. Since we have Mr. Litterman back, we will allow him to speak. And we, as soon as Mr. Litterman finishes, I will see if Assemblyman Palumbo wants to say anything. Yes, we see you there, sir. If he wants to say anything, hold for a minute, sir. We'll see if Dr. Litterman wants to finish.
Great. Well, thank you, Senator. I just wanted to say hello. We're getting busy now in budget time, so I'm sorry that I'm late, but it's good to see you, and I certainly look forward to your testimony. So thanks again.
Thank you, sir. Thank you. Mr. Litterman, before the AT&T catches up with you.
Yeah, I'm back. Hopefully I won't be dropped again. Thank you. I'm not sure where I was when I got dropped.
Why don't you make your closing minute and a half of statement?
Okay, well, I think what I was probably trying to say is that the most important thing the government can do is put a price on carbon. Now,
I am not a conspiracy person. You froze again, sir.
Oh no. Well,
I would encourage you just to go straight to your point. The price of carbon.
Yeah, this topic is so important, and what we really need to do from banks is make sure that they understand the climate risks that they face and that they disclose it to investors and stakeholders. Thank you.
Well done. Well done. then I will raise a question. What I will yield to my colleague, Rachel May. Senator May, yours is the first question.
Thank you so much. And this is really for the mortgage bankers. But Mr. Litterman mentioned living in California and the wildfires. I have two relatives who live in California who swore they would never shovel snow ever again in their lives, but they're talking about moving back to the Northeast now because of the dire climate conditions there, the extreme heat and the fires. So I'm just wondering if the Mortgage Bankers Association is preparing for a what could be mass climate migration to our part of the world where we expect to have some of the only fresh water available on the planet, and a pretty mild climate compared to elsewhere in the planet. So I'm just wondering if that's even on your radar. Or is that something that you're thinking about?
I would say that right now on our radar is the extreme housing shortage. And if the shortage of inventory, and if more folks are coming back into New York or coming to New York, that will exacerbate the situation. But we're ready to lend, so long as they can find housing and a place that they want to call home.
Okay, thanks.
Thank you. Both are.
Can I have a follow-up too?
Absolutely.
Yeah, so I also asked one of the previous witnesses about the issue of how we go about supporting efforts, for example, to weatherize, to make buildings net zero, that kind of thing. Is there room in the sphere of mortgage lending to incentivize that kind of, especially new building, but also existing buildings to be brought into line with our desires for, greater fuel efficiency and that sort of thing?
There are renovation loans offered, both backed by the government as well as the GSEs. And so long as those programs will acknowledge and allow for making homes greener or more sustainable, then if that's allowed by those programs, then they can be financed.
And is there room for legislation that would make it actually a requirement, or make it more favorable terms for people who are taking their homes in the right direction and not in the wrong direction when it comes to energy demand?
Now, Kathy, do you have any thoughts on that one?
So from a lending perspective, what I would offer is that, affordability is also a major concern along with the housing shortage. So it could be a very costly endeavor for a new, especially in the first home buyer arena, for them to try to bring up a property into some type of required coding or things of that nature. And if the GSEs or the federal government programs don't offer some type of allowances to include those upgrades or what have you in the financing of that home, then that could be problematic for the home buyer, especially since, we all know that housing costs are rising, utility costs are rising, property taxes are rising. So what a new homeowner can afford is becoming much smaller, especially with the lack of inventory. So hopefully that gives some information on that.
Okay. Yeah, thank you.
You're welcome.
To continue Senator May's line of thinking, a energy smart home of the future may couple solar power with, if wind were available, wind and geothermal. We currently have grants for solar. I have a bill trying to get a tax write-off for geothermal, but what is the financial industry doing to incentivize this type of thinking, to have us go even at your level, our level, towards these directions? What are you guys actually doing to incentivize smarter future, a smarter, better future?
Christina, I'll respond. So, I personally work for a community bank. So our lending programs and the parameters that we lend in are dictated by what we participate in as far as the GSEs or HUD offers. So just as an example, the solar efficiencies and those borrowers that plan to participate in that, it was a little bit of a timing issue, I would say, where, the GSEs recognized that people were taking part in these energy efficiencies and how they were treating it in the lending programs, to then give guidance to the lenders on how we could support our borrowers in doing that. So as Christina mentioned earlier, it needs to be a very collaborative approach, because if we're offering something to a borrower that we can't support because of other factors, then the advantage for that borrower is not going to be realized. So there's a lot of opportunity for sure, but there's also a lot of parties that need to come together and find a solution to how to get that ultimate, homeowner in a good situation. Christina, I don't know if you had anything to add.
Nope, I think cover that.
Well, I think that I don't know about you guys, but I really enjoyed this whole panel so far. Everybody, I've learned a lot from the moment we first started going, and it's hard to say which one is the best. Just when I think that I've gotten the best, then here you come. So I'm grateful for that. It would encourage you to. Somebody had to put out best practices. The Federal Reserve said it's basically not them. I'm not sure what DFS said on that issue. But if I could encourage you guys to the NYMBA to put out what are the best practices. For example, we just heard about CRA and resiliency. Now, I don't know if anyone has used it in that fashion yet. So if you know of anybody using it, please let me know. But if not, we need to really pioneer these things. And I certainly am going to do work in my local community. We're about to plant 100,000 trees in my local community. It's a flood zone. Trees are great for that area, and for so many different reasons. I did not think of going to any of the local banks to help. I didn't think of it. It shows that even I have to think more on this. So we all need to think anew. And has anyone bumped into the metrics that Dr. Ingalls was speaking a moment ago? Are you guys familiar with his metrics?
I have not.
Okay. I wasn't either. So I will. When I get it, I'm going to take it upon myself to get it and then share it, so at least we'll know what's out there. and we may find some use for it. Ladies, again, I'm very grateful for your continued advice that you have given me over the years that I have learned from, and you're being patient teachers for such a slow student, but I'm really grateful for it. Is there any final word that you wish to say, or Senator May, or let you have any final word for this panel? Panelists, is there anything final?
No, sir.
And I want to
Thank
thank
you.
you both for being here, and thank Dr. Litterman for attempting. It just shows we have to work on the broadband issue also, but one battle at a time. Thank you for being here. And if the next panel is here, Ivan, you can call them up. Thank you very much. I'll see you soon.
Thank you, Senator.
All right, Senator Sanders, the next panel will include, wait, there's 2 more people got let in.
Okay, take your time to let them in.
All right, so the next panel is going to be Richard Schrader. He's with the New York Policy and Legislative Director for NRDC. He'll be followed by Stefan Adel, who's the coordinator of the New York Renew Coalition. He'll be followed by David Arkish, excuse me, I already butchered up your name, too bad, Managing Director of Public Citizens Climate Program and a fellow at Roosevelt Institute. Then he'll be followed by Tusif Ahsan, he's with the New Economy Project, followed by Colin Reese. So everybody have 3 minutes for your testimony. And Richard, if you begin the program, we appreciate you. Thank you.
Thank you.
Set the clock properly, and I trust that everybody heard the direction that we're going, what order. Please, sir, you can begin.
Thank you, Senator Sanders and Senator May and Senator Kaminsky. I'm not sure he's still there, but Senator Sanders, a very important hearing, and I'm glad to be here. I'm Richard Schrader. I'm the Policy Legislative Director for the Natural Resource Defense Council in the Northeast. As we see every day now, but today particularly, after yesterday's Intergovernmental Panel on Climate Change, their report, the climate crisis occupies every corner now of the global social and economic fabric. I want to give one quote from Deborah Roberts, who was a co-chair of the panel. She said that in order to really tackle climate change, government, civil society, and the private sector has to, quote, work together to prioritize risk reduction as well as equity and justice in decision-making and investment. You know, the financial service industry plays a critical role in society generally, but it could play a very critical role in reversing the most salient cause of climate change, which is the expansion of the fossil fuel sector. But it hasn't gone in that direction. According to the research group BankTrack, from 2016 to 2020, the 60 largest private sector banks invested $4 trillion into fossil fuel projects, assets, and companies globally. A lot's been said already about the physical and transition risks. I'm not going to repeat all of that. I do want to point out, though, the issue of transition risk is really central here. As state governments, federal governments, and other national governments hit their climate goals, as they electrify across the board for buildings and heat, as they electrify for transportation, you'll be seeing a very different and dramatic shift in the economy. And banks that have assets continually invested in fossil fuel could have an enormous and very quick, rapid deflation of their assets. It's dangerous for them as well. And of course, the physical problems we already see as we see decline and damage of the physical properties that they invest in. It's important to note that the New York State DFS and a terrific team over there has really been a kind of a national leader in setting out new terms for the industry to try to manage climate risk generally. I just want to point out 4 components of their guidance letter they sent out a little more than a year ago to the CEOs of the industry. One is that the regulated organizations, the banks and insurance companies, need to put into their governance framework an overall business strategy to look at how to manage risks as far as climate change. Two, designate a board member or assign a committee to be accountable to the institution as far as how these are going to be creating new risk management practices.
Lisa.
And then most importantly, prioritize climate-related financial risk disclosure. Make this public, prioritize it, and then take concrete, transparent steps to mitigate those risks. This came from the New York State DFS, and we see it resonate across other regulatory agencies. Nationally, the control of the currency has pretty similar guidelines. We've also seen the Basel Committee on Banking Supervision use virtually the same language about a year later in their letter. Let me say this, of course, and it's been said before, but those economically most vulnerable communities are going to be most vulnerable for a number of reasons, as you know. Frontline in terms of damage done on the physical side, but also there's already a reduced access to capital, and this is only going to multiply that problem. Let me complete, my comments here by a very, very brief set of suggestions that legislators could look at in New York.
If you can do it
At the
briefly.
very least, at the very least, have the legislature look at the financial service industry to bring its policies in line with New York's landmark Climate Leadership and Community Protection Act, CLCPA. That law has metrics: 70% renewable energy by 2030, 100% zero emission electricity by 2040, 40% reduction of greenhouse gas emissions by 2030. Have the financial industry create their own set of risk reductions, but also investment policies that will align itself with the CLCPA's important goals. Secondly, make it public. And third, have it as an annual disclosure so that every year they have to say how they're making steps, taking policy advances to reach those goals. I think what we saw with the Comptroller's Office in New York and the Common Retirement Fund's divestment, that's a very good example of how you can do this over the long term and begin the divestment process in a strong and aggressive way. Thank you.
Sir. Thank you.
And Stefan, you're up, followed by David.
Thank you very much. Thank you, Senator Sanders, Senator Krueger, Kaminsky, all the other May, all the other senators and assembly folks and staff and witnesses today. It's an honor to be here. I'll try and be very brief and look forward to questions. Climate change and instability are already here, right? We just had another IPCC report that really drives home how much this is already affecting the landscape. And we have a landmark law in New York State, the CLCPA, it's been mentioned. And so I'll start by recognizing that it is an important step that DFS has actually started to try and regulate here, that this hearing is going on, and that we're seeing the beginnings of trying to regulate the finance sector in relation to climate change. It is something New York can really lead on. I'd also be remiss if several folks have mentioned the question of a carbon tax in prior panels. I didn't name that New York Renews has been working with Senator Sanders and others to work on legislation around a polluter price, doing it equitably, doing it right, and investing in our transition. And so thank you to all of you who've worked on that and the continued conversation there. I'll focus my comments now, and I know others coming after me will as well, less on the risk to finance of climate crisis than on the risk we're all feeling and aimed at us because big banks and financial institutions are driving the climate crisis, not addressing it. Richard and others have thrown out some statistics. I'll throw out others, right? That less than 5% of overall investments and loans are going to the clean energy economy as opposed to 95 or more from banks in particular, but also across sectors to the fossil fuel industry. We continue to see fossil fuel industry investments and investments in false solutions that are leading, even when there are questions about the long-term investments that are coming up, whether it's oil and gas pipelines, coal plants, offshore drilling sites, indigenous land violations around other false solutions, toxic leaks. None of these costs are being considered, and the beginning of a regulatory framework that will force finance sector actors, including banks, but also private equity firms and others, is a key step. And the legislature needs to continue creating new regulatory tools for DFS and others to use and looking at key ways they can move forward. there are a lot of problems with the way we do climate finance at the moment. They leave out low-income households. They leave out those with any barriers. And it's not just about what the banks do. It's about how regulators and program administrators are then impacted by secondary market and bank conditions. So there's a lot more to say there, but we've seen how much it restricts the ability of NYSERDA and others to do their job when they have to then pay attention to the most conservative small c version of how the banking sector wants to proceed. We need new tools and new alternatives. One of those that could happen is to dramatically increase investments, and I'll wrap up with this last thought, in this year's budget to allow the state to change things. Another would be the creation of a New York State Bank. We know that there are a tremendous amount of limits to how much of a regulatory actor New York State can be, but as an investor, as a depositor, creating a New York State Bank would open a whole new set of toolboxes, just as divestment and just as public investment do. So thank you, and I'm happy to answer questions.
Thank you.
Thank you. Dave is up, followed by Mr. Hassan.
Thank you. This hearing comes a day after the release of the IPCC's latest report on climate impacts. That report underscores the critical importance of banking regulators and legislators taking a precautionary approach to climate risk, one that phases out financing of greenhouse gas pollution in line with the IPCC's climate targets while helping vulnerable communities navigate the transition. The report shows that the harms of global warming are already much worse and more widespread than expected, and they will worsen severely if we continue on our current trajectory of greenhouse gas pollution. This should be a wake-up call for banks and their regulators. Most have recognized in principle that banks in the financial system face substantial risks related to climate change, but little progress has been made on actually managing the risks. A recent ECB survey found that banks view climate change as a material risk, but 90% of their practices are not in line with regulatory expectations on climate risk. So too often, banks and regulators cite the need for more data and better models as a reason to delay action, but that's exactly backwards. Every update from climate scientists shows that the effects of climate change are worse than models had previously expected, and inaction is the worst possible response. The way to deal with that residual uncertainty regarding climate risk is a precautionary approach, under which banks and regulators prioritize reducing risk even where they lack full certainty about its magnitude or probability. In other words, a lack of data or models should be a spur to reduce risk, not an excuse for inaction. A bank adopting the precautionary approach would take on less risk than its models deem acceptable, would recognize that hedging and insurance will be of less value than they are regarding other risks, and would pay special attention to low probability, high magnitude threats. The bank would also plan for likely failures of its attempts to proactively manage risk and invest in resilience for both its physical operations and its balance sheet. The IPCC has also made clear there's only one solution to the threat of climate change, and that's a rapid, orderly transition away from fossil fuels and other high emission activities. Prudent risk management by banks entails both preparing for the transition and playing a part in bringing it about. That means phasing out support for high emission activities in line with science-based targets. And following that path will both help make banks more robust to volatility in sectors threatened by the transition, and of course, help reduce the harmful emissions that are driving the crisis in the first place. Regulators and legislators have a critical role in protecting the financial system by directing banks to adopt this precautionary approach and clarifying expectations regarding what it actually means. It's also important to note that policymakers need to cushion vulnerable communities from the negative effects of climate risk management. Already, we're seeing insurers withdraw from climate-impacted areas. That means banks will follow close behind. And these areas are often home to communities that have been the victims of generations of racial and economic discrimination. Regulators need to protect banks from compounding this legacy of discrimination with harmful decisions regarding how to manage climate risk. There's a key role for you to play and the legislators in terms of both shaping rules for bank behavior to protect these communities and identifying alternative methods of directing credit and investment in them. We can't delay any longer. I urge you to take rapid action to shift banks away from fossil fuel finance and toward a responsible precautionary approach to climate-related risks. Thanks.
Thank you, David. Mr. Hassan and Mr. Rees will close us out.
Thank you. Just want to say that we understood that we'd have 5 minutes to speak, so I'll try to keep my remarks short, but would also appreciate your understanding. So good morning, Chair Sanders and Senator May. My name is Tausif Hassan, and I'm the Public Banking Campaign Coordinator at New Economy Project, a New York City-based economic justice organization. Thanks for the opportunity to testify today. So our colleague Stefan actually pointed this out, but you know, the IPCC came out with a recent report warning that the impacts of climate are worse than expected and happening more rapidly than we previously thought. And scientists have been telling us for decades that fossil fuels are wreaking havoc on our environment and that bold, considered action is needed to address the climate crisis. And yet in the 6 years since the Paris Agreement, banks have poured over $3.8 trillion into the fossil fuel industry. Banks' funding of fossil fuels is accelerating the climate crisis, and it's becoming deadlier each year. Here in New York, we're already seeing the harmful effects. Last summer, Hurricane Ida bombarded Nassau County with record amounts of rainfall and flooding, shutting down the LIRR, forcing people to evacuate their homes and even trapping people in their cars. The storm left 15 New Yorkers dead as it blasted through New York City, flooding streets, buildings, subways, and most devastatingly, unregulated basement apartments in low-income communities and communities of color. The IPCC's report is acknowledging that it's really the people of color and other vulnerable populations around the world that are most impacted, and we're seeing this happen in New York as well. So New York's lawmakers and regulators must take immediate action to prevent financial institutions from continuing to invest in dangerous fossil fuels. At the same time, New York should advance local public banking by enacting the New York Public Banking Act, sponsored by Chair Sanders, this session to help local governments invest in climate solutions and divest public money from banks that are fueling the climate crisis. New York is uniquely positioned to lead on this all-important issue. For one, banks operating in New York are among the largest funders of fossil fuels in the world. Many of the world's largest financiers of fossil fuels, such as Chase, Citibank, Wells Fargo, and Bank of America, do considerable business in New York. In fact, Chase is both the largest bank operating in New York in terms of market share of deposits and the world's largest funder of fossil fuels. New York State chartered financial institutions are also funding the climate crisis. Banks chartered in New York are pouring massive amounts of money into the fossil fuel industry, hastening the crisis. For example, Barclays, BNP Paribas, Goldman Sachs rank in the top 15 of fossil fuel funding banks. In the 5 years following the Paris Agreement, these 3 New York State chartered banks financed fossil fuels to the tune of $366 billion. New York must enact legislation that prohibits insurers and state chartered banks from investing in fossil fuels. Finally, banks holding billions of dollars in public deposits continue to pour money into the fossil fuel industry. Some of the worst offending banks hold massive amounts of public deposits in New York. JP Morgan Chase, for example, holds more of New York City's public deposits than any other bank. And again, they're also the largest funders of fossil fuels in the world. So through local public banking, local governments could divest from banks that fund fossil fuels. The New York State Senate should pass the New York Public Banking Act, sponsored by Senator Sanders, which creates a safe and appropriate regulatory framework and provides consistent statewide guidance for public banks in New York. Through local public banks, New York cities and counties could divest public deposits from banks that fuel climate destruction and invest in ecologically sustainable development, such as community-controlled renewable energy and other sustainable infrastructure. There's a lot of momentum for local public banking in New York State. Recently, 150 community, labor, and small business groups signed a letter in support of the New York Public Banking Act, and the legislation has been co-sponsored by 53 assembly members and 28 senators, and has the backing of numerous local elected officials who want to bring public banking to their communities. Addressing the root cause of the climate crisis means challenging runaway fossil fuel funding as we work to build new institutions like local public banks rooted in racial justice and ecological sustainability. Thanks again for the opportunity to testify today.
Thank you, sir. Last but never least.
Well, I will let you all decide that, but it is great to be here today. I appreciate the opportunity to testify. My name is Colin Reese, and I direct the U.S. program at Oil Change International. We're a global research organization with over 15 years experience in advocating for the world's financial institutions to shift their investments from fossil fuels to clean and renewable energy. I was actually one of the authors of the most recent Banking on Climate Chaos report, which Mr. Schrader and Mr. Assad mentioned and cited some statistics for, which we publish each year alongside our partner organizations. And so Today, I'd like to stress the importance of not solely examining threats posed by climate change to the banking system, but also the threats posed by unsafe banking practices that are driving the warming of our climate and threatening our most vulnerable communities by expanding fossil fuels. It's my view that such practices are concerning enough to be worth addressing on a climate basis alone, and I think many here would agree with me. But it's also worth noting, to bring it back, that this widespread financing of fossil fuels greatly exacerbates the financial risks on banking posed by climate change, both to these financiers' own institutions and to the banking system as a whole. Which is to say, banks aren't simply facing high financial risk from the climate crisis in an abstract sense, but are actively engaged in escalating those risks as well as endangering our climate. As mentioned, our most recent edition of the report analyzes the financing, which is the lending and underwriting of stocks and bonds, from the world's 60 largest banks to oil, gas, and coal companies. We identified about 2,300 such companies around the world that received financing from these 60 banks. The 60 banks in our report cover several major New York financial institutions, including JP Morgan Chase, Citibank, Morgan Stanley, and Goldman Sachs, as well as the institutions Mr. Hamann mentioned, which comprise many other banks that do business in New York, but those are just kind of solely New York financial institutions. I think you're well aware that New York's role as a global financial hub gives its banks sizable influence on global financial happenings and trends. But that also means that the committee members here today can play a critical role in prudential regulation to manage the risks posed to and by financial institutions to the state of our global climate. These 60 banks provided, as mentioned, nearly $4 trillion in financing to fossil fuels over the last 5 years after the Paris Climate Agreement was adopted. And despite the massive drop in both fossil fuel demand and production due to COVID-19 in 2020, this financing of fossil fuels decreased only slightly and remained still higher than 2016 or 2017. Over that time period, JP Morgan Chase was the #1 banker of fossil fuels. Citibank was #2 at a global level. Morgan Stanley was number 12 and Goldman Sachs was number 15, combined more than $750 billion to fossil fuels just from these 4 institutions. I'll close by saying it's important to note that our analysis does not extend to many local and regional banks, including many across New York, and that there are indeed some banks implementing policies to shift the numbers above, as well as governments instituting regulation to force them to do so. We have Credit Agricole, UniCredit have committed to end support for companies expanding coal. La Banque Postale has done the same for companies expanding oil and gas. But you'll note that none of those list of global leaders includes New York's biggest banks and some of the globe's biggest banks. I'll close by saying that New York's impressive status as a national and even global leader in climate policy is threatened by this fossil financing pouring out of Lower Manhattan, which also threatens the stability of the entire financial system, as we've heard today. But that same record of climate leadership gives me hope for enhanced regulation and a different path forward in coming years.
I thank you. I believe that that's everyone on this panel. Let me start by saying that, gentlemen, if there's any report that you believe that I should have and should read, please make sure that you get it to me. I actually read this stuff. I actually sit up and to me, it's life or death, not just from a theoretical point of view. When I leave from these glorified marble halls that we have here, I'm headed to the Rockaways, Queens. As I said earlier, that is the lower 9th Ward of New York City. Whatever is going to happen to New York City in terms of climate change, I'm going to feel it first. We're absolutely going to feel it first there. So please, if there's anything that you can give me, I'm short of a public bank, which I absolutely support and think that we should do. What else should New York's, the state Senate, be doing on this issue in terms of banking and climate change? Sir, I saw your hand.
Yeah, thank you again, Senator. And again, quickly, I said it in my brief statement. I think it's time to look at legislation, and the legislation should be something very clear as far as disclosure among banks, the large banks that others have spoken about that, are part of that 60 bank, 100 million, say, gross receipts a year. Disclosure in terms of what their continued investment in fossil fuel assets are annually, with an eye towards having them shift their risk reduction and shift their policy in terms of getting out of that. And one way to look at it is to look at what controlled DiNapoli achieved with his divestment plan over some time, but looking at the worst, most greenhouse gas emitting, most polluting fuels, and then moving towards the rest with an eye towards 100% divestment. I think that's a terrific first step for the legislature, and one that certainly NRDC would be supportive of, with a number of other component parts to it, which would include possible penalties for not hitting certain metrics. But thinking about the DFS excellent guidance note and thinking about the CLCPA, which is landmark, those are great starting off points to start looking at a disclosure process for the financial services community.
Why don't you work with me on that one, on the Sanders-May bill, or the May-Sanders bill on this issue?
Look forward to it.
I look forward. You wanted to say something, sir? Stephen.
Oh, I wasn't sure if somebody else. I mean, I would just add it. That's sort of a long way away, but two really concrete actions are, we know from experience with on-bill recovery, with Green Jobs Green New York, as well as other programs, that where the state takes an aggressive role in setting the standards in an industry, whether that, just as it does on the labor side, setting low interest rates for working class homeowners, setting other programmatic functions. And so making sure that in this budget, there is increased funding for those effective programs, which largely rely on ratepayer fees, but also that those funds are tied to programmatic direction for NYSERDA to ensure that we are seeing, those funds actually deployed. We've seen how incredibly effective they are at getting money and projects out the door, but also that really leaning on the state's role to drive what those programs look like, which is because of the secondary market, because of the banks and the reliance on securitizing those loans after the fact, without real attention from the legislature and public financing, we see those loans slide more and more like market rate loans.
Why don't you work with Paul Alexander at my office on that one? Senator May, you wanted to raise a point.
Yeah, thank you. And I am proud co-sponsor of the Public Banking Act. I wanted to follow up with Mr. Adel about the New York State Bank, which isn't something I had thought about before, but you said that it would have, there were a lot of tools that it would open up to the state. Can you elaborate a little bit more on what those are?
Sure, and I could certainly let Tausif and others weigh in. Whether it is authorizing the legislation that's pending now to authorize local state banks, or the real dramatic shift that would allow New York State to have a bank, the fundamental goal is to leverage those major deposits in order to have new investments that are in line with the direction that New York State is setting. New York State has, $200 billion in budget that is deposited in banks in various pieces, the STIP and other depository accounts. So the same logic that applies to the public banking bill for localities could apply to the state level. It is more challenging as a regulatory matter, and I'm sure Tausif and the senator can talk more about why, as a strategic matter, that is not the direction that the bill is focused on at the moment. But just to say, the same arguments that are there for public banking at the local level are there for the state level. And we could decide as a state that we wanted to really leverage those funds through a public bank, or through a much stronger state infrastructure bank that's focused on green banking. Not, my apologies, not to say anything critical of the green bank, but that is very fundamentally different as it exists now under NYSERDA than, a true public bank or even an infrastructure bank.
Okay.
Just a point of information, there are two bills, complementary, my friends. One says localities can create a public bank. The other one says the state will create a public bank. They are complementary.
Thank you.
So my other question has to do with credit unions and just what is their role in all of this? Because we have a lot of them in New York State, and at least in Syracuse, where I live, they do really good work in a lot of areas of the community.
So why don't you take both of those questions? You wanted to weigh in.
Yeah, of course. Thank you. So to answer Senator May's question about the role that CDFIs play in helping us to fight the climate crisis. So we're advocating for local public banking through the New York Public Banking Act. We definitely believe that the state should move on this because the bill is right here, right now. And once we pass that, we could definitely get moving on a state bank. But our model is that local public banks could leverage local municipal public dollars and use that money to capitalize, finance, and support CDFIs. And the CDFIs would basically be the community lending institutions that are the best judges of what are the renewable energy projects, what are the sustainability projects that are good for the community and are the ones that should be funded. So the local public banks would be able to provide public dollars to make that happen, and the CDFIs would be the actual lenders to choose the specific projects to move forward on. And then to answer your previous question, Senator Sanders, about aside from public banking, what can we do right now? We really believe that we need to go beyond disclosure. New York State should enact legislation that bans state chartered insurers and state chartered banks from investing in fossil fuels. If you're looking for a precedent, I believe that there is legislation that has been introduced in the Senate that proposed banning state chartered banks from investing in private prisons, for example. So it's not something that's unheard of, and these are solutions to this problem.
If there's no follow-up by you, Senator May.
I'm good.
And I want to express my gratitude to this panel. I have learned so much from you, and New York State owes so much to you for your continued advocacy, just pushing. We're starting to get it. It's starting to catch on. May it catch on. We don't have much time. We all saw the UN report that was saying that we really, to some degree, have run out of time. And to God willing, we get it and not rue the day looking back and saying, we had enough time to do this. Well, let me thank you again in a very positive fashion. We really appreciate your push, your direction. We need you to do exactly what you're doing, to give voice to the voiceless, to just insist that there is a better way, a more rational, sane way of living. And whether you look at any of the great struggles, look at struggle against apartheid. People said, it'll never work. It worked. The struggle to deal with some of these nuclear weapons, to some degree, an ongoing struggle. The struggle to deal with slavery, civil, any of these women's rights, any of these struggles. At some point, everyone was saying it's ridiculous, it won't work, forget about it. But people were able to persist. Now, let's help the banking community see and get an understanding quick, fast, and in a hurry. I want to thank you all for the work you've done. Send me every report that you think I should read, because Rachel has said that she will read every one that I don't. So, and that is a lot of reading, Rachel. So thank you all for being here. Ivan, I trust that the next panel is being geared up. I look forward to seeing you on the front lines once again. Thank you.
Thank you, Senator.
Thank you.
Thank you, Senator. Much appreciated.
Assemblyman Paulino, how's it going? I'm learning a great deal from this stuff. I didn't know half of this. Did you pick up on anything? Was anything interesting to you, sir? Assemblyman Paulino.
Colombo.
Palumbo.
Palumbo.
I have no idea. I can't see the thing on the screen. Mr. Palumbo.
Yeah, Senator Sanders, I know you were talking because I'll always be an assemblyman at heart. You know what I mean? Even though because we haven't been in the chambers in the Senate. You know, I mean, we haven't been able to see each other live. I do think it's interesting, and I know the the divestment issue has been something that can go both ways. And I've actually argued on the floor that sometimes we have our banks and even like the pension funds with Comptroller DiNapoli, when we have a seat at the table, we can have some leverage instead of just not putting our money directly into those fields. So, it's a mixed bag of emotions on my end. And of course, I think we absolutely need to make the transition from fossil fuels. I agree with that. And I think that all of our speakers are on the same page. Just that's something that comes to mind when we talk about divesting, I guess, from certain types of investments that, it may not be the most prudent financial move, but I think almost from a strategic standpoint, we may want to always consider if we have significant funds in these areas of business that we can at least force them in some way to, start thinking about our climate and globe instead of just making profit. So that's just.
Go put Senator.
Thank you.
Well, at least I'm consistent. If I'm going to mess up, I'm going to totally mess up. And all I can say, if you think Tuesday is bad, wait till Wednesday. You should see me on Wednesdays. We are finally, I believe this is our last panel, Mr.
Yes, it's our last panel. And on this panel is Dr. Edward Williams, president of the Regional Ready Rockaway. He'll be followed by Sandy Pope, who's president and CEO of Sister Girls for Clean Water Corp. And then it's going to end with Kevin Alexander, president and CEO of Rockaway Development Revitalization Corporation. Everyone has 2 minutes.
Ends with Kevin Alexander, I always say.
Everyone, you got 2 minutes for your comments, and there'll be a question and answer period after that. So please begin your testimony, Mr. Edwards, followed by Sandy after that.
Good to see you, Doctor.
You too, Senator. Thank you very much for the opportunity to testify on the ongoing trend of climate risk and banking. This includes, of course, higher temperatures and more extreme weather, which will result in economic and financial losses to many of our businesses, households, government, and of course, financial institutions. Moreover, the uncertainty about the severity and timing of these losses is a source of financial risk as well. I believe, excuse me.
It's Tuesday, sir. We can
Tell me about it. I believe there's an immediate and compelling need for the rebuilding, of course, of our America's worn and damaged infrastructure, fiscal and organizational systems and facilities, which we need, which the need is particularly critical within our coastal communities, which comprise of only 10% of our nation's land masses, but account for 42% of the national gross domestic product. Approximately 159.6 million people live in these packed coastal communities, including the state of New York. And finally, I'm gonna be succinct because we only have 2 minutes, and you know I can be long-winded. But I also, don't laugh, Senator, I also submitted a written testimony. So I will end by saying that carbon, while it's clear that decarbonization, a rapid, just transition to renewable energy is the ultimate strategy to combat climate change, we must be clear that the resilience and the adaptation are the most important strategies to meet the need of our immediate risk of climate change and banking, climate and banking change as a risk. And I hope I stayed within my 2 minutes, Senator.
It was 2 minutes, Edwin Williams style. I thank you for that, sir. Ms. Pope, I believe that you are next, Ms. Sandy Pope.
And Ms. Pope, if you could turn your video on, please, because the audience cannot see you.
Okay, I don't have video. Thanks a lot for inviting me on this panel. I think it's extremely important. I've learned a lot about the investments, the bank investing in fossil fuel and trying to make those kinds of changes. But I haven't heard anyone talk about the educational system. We must educate our young people. They're the ones that are recipients of this climate change, but nobody's advising them on their diet that infuses the methane gas and fossil fuel. So my little organization with girls, I try to educate them, but most importantly, we have to get the kids involved and get them get that involvement with letting them understand their part that they play with climate change. Because if their diet is not working to support impact climate change, then it's working against climate change if they're not working to support it. So we need to educate them on a different kind of diet that can support and impact climate, but they need to be educated to understand why this is happening. Because as I said, if they're eating junk food three times a day, 365 days a year, that's making major impacts on fossil fuel and methane gas that's emitting into the in the environment. Senator Sanders, I think we need to look at a program. I might have a few programs that we can ingest into the educational system, but that's extremely important, because unless our young people understand their part they're playing in this climate change and global warming, then the global warming will continue. Everybody will put money into funds into fossil fuel and all these other ideas that were suggested today. But if the kids are not involved, if they don't understand, then we're working on a two-edged sword. They're the recipients of this global warming and climate change in the future. So if they don't understand it, then we'll still be putting funds in a revolving condition that they will be, as I said, recipients, but then they will not understand their part that they're playing. Any questions?
Not yet. We have to let the ubiquitous Kevin Alexander speak first, and then we'll see questions. And he can tell me what that word ubiquitous means, since I clearly do not. Mr. Alexander, you're on mute, sir. You're still on mute.
I will try and be eloquent in 2 minutes. I want to thank you, Senator Sanders, Krueger, Kaminsky, and I see Palumbo still on the line, for the opportunity. RDRC is located in Far Rockaway, Queens. Our geographical service area is one of, if not the most remote area of Queens, and maybe all of New York City, known as the Rockaways. My organization provides programs for youth, adults, homeowners, renters, and business owners. So we see the entire envelope of one geographical location. Climate change has greatly affected how we live and do business in the Rockaways. And one might say that we're not only we're still not as prepared as we were post Sandy 10 years later. The challenges that we're facing now with climate change are several. One, we're concerned with the impact of any legislative change on banking and divestment in fossil fuels. What will the impact be in our local communities? Will that be another excuse for business to say, or banking to say, this is a reason why we don't make more CRA investments in our community, as another tool in their toolkit? So we have to take a look at the local level of the impact of divesting and what the opportunities are, whether it be a public bank, a local bank, working in conjunction with CDFIs. Where are the opportunities? What will that gap be? How will it be filled if we do divestment in fossil fuels that might fund some of the programs and services and infrastructure in communities such as the Rockaways? Has that been considered, and will it be considered as we move this regulation and plan regulation and policy change forward? Thank you.
Well put. I see Senator May, you have the first shot at it if you wish.
Well, Senator May, if I may interrupt for 1 minute, please. We do have another guest, another panelist who was on panelist C, but had technical difficulties. He finally got on the call. So if he's available, let him to say a few words. His name is
Please,
Ivan.
anytime we have Amalgamated Bank, please tell Labor that I said, I love Amalgamated Bank. Quote me. Ivan from Amalgamated Bank.
He's Senior Vice President and Chief of Sustainability Officer at Amalgamated Bank. Ivan?
Which I love.
Thank you, Senator Sanders, and thanks for letting me in. I submitted testimony. I think I was in the kind of 8-minute slots. I'm not sure I can really do this in 2 minutes, but I will say we have been a climate leader on this. We've developed a global methodology for measuring financed emissions. We helped to found the Net Zero Banking Alliance and wrote the target setting guidelines for that alliance with a couple of other global banks. The global banking sector is fully aligned around this. The general points I had been planning on making, which are sort of expanded in the written testimony I provided, are first that we started with, and I think banks have to include an impact-based approach to this. So we can't just think about it as a risk-based exercise because, or assessing risk at the institutional level. We have to be obligated to the impact that we are having, and people know well the impact that banks have, whether it's on racial inequity or whether it's on funding fossil fuels, and we have to be upfront about that. In most of the banking now, 45% of global banking assets is a part of the UN Principles for Responsible Banking that commits to sort of action on impact. The second point is our approach to disclosure. So we have invested heavily in disclosing financed emissions and being responsible for that. We've disclosed 2 years worth of emissions data for everything that we lend to. And we're in the process of preparing our 3rd year of that. And I think that is now recognized through the Task Force on Climate-Related Financial Disclosures as something that banks should do. In European banking regulations, they are requiring that kind of disclosure. And my anticipation is that the Securities and Exchange Commission is going to do the same over the course of this coming year. In terms of physical risk, because I know that's been a big part of the conversation, we are working to and that is particularly relevant for community and regional lenders. We're not exposed to significant transition risk because we're not lending to big fossil fuel companies and outdated technologies. And so we are paying a lot of attention and looking at the data that we can use to understand both at a transactional level and a portfolio level what the physical climate risks are, whether they're wildfires in the West or storm surge or various types of flooding on the East Coast. So we are doing that. We are hoping to do that collaboratively. We've been working with NYSERDA and others on a sort of an approach to do this work of incorporating physical climate risk data and coming up with best practices that can serve the whole sector and tie up to the kind of regulations that both the OCC and DFS are considering, which we applaud both of them for their work there. And then finally, the thing I would say about risk is that it is inadequate to look at this at an institution only level. We have to, for policymakers, look at it from a systemic risk perspective. And the reason is that climate is a sort of an enhancing risk of all other risks. And it sort of supercharges everything else. And it takes impact at a level systemically at the point when you can't do anything about it. And so first of all, there's a lag. So if we were to immediately bring all of our emissions into a line with a 1.5 degree temperature scenario, the temperature increase and the impacts in that are baked in. So we're going to see that for decades to come, even if we started to immediately reduce our emissions. Now, unfortunately, the reality is we're going to still keep pumping emissions for some time, and we're going to have this delayed reaction. And so by the time a policymaker or a regulator figures out that there's like systemic risk that's about to happen, there is nothing you or a regulator will be able to do about that. And so this is why I think particularly at the federal level, but regulators need to look at systemic risk as well. So with that, I realize I'm way over my 2 minutes and we'll conclude.
Well, we really appreciate your struggling to get in here, sir. Very sobering, your remarks. I'm going to go back to the different regulators and organizations, and I'm going to ask them, have they looked at the amalgamated bank strategy? So please send me some more information and make sure that I know, because I'm searching for best practices. And indeed, you may be it. You may have some of the best practices here. So please make sure that we have this. I will yield to my colleague, Senator May, who wanted to speak earlier.
Right. Yeah, I was going to address this to the original panel, but Mr. Frischberg, some of the things you said really resonate as well. I'm thinking about the systemic picture. I know, for example, plastics are an area where it's a very important piece of the fossil fuel economy. I don't think we focus on it very much, but we should. And so I'm wondering if that gets folded into decisions about addressing climate emissions through investments. But the other one is waste. So, and Ms. Pope, when you were talking, I was thinking about this. So I know the Climate Action Council in their deliberations weren't thinking that much about waste as part of the picture. And by the end of their year-long deliberations, they were totally focused on waste because it is a huge piece of the puzzle. And so I'm just wondering how a lot of the costs of waste are borne by municipalities, not by the companies that produce the waste. And so how do we get that into the calculus of deciding about what is a good investment, what isn't a good investment, and what actions can we take to elevate that?
The first thing I would say is this is a really good example of the most effective sort of like how to approach this from a real economy policy perspective, because in the plastic sense, there are what they call scope 3 emissions, right? So these are supply chain emissions, which if we then as a financer of anything around that, honestly, whether it gets factored in at a broad level into an end use client or a production client, a bank has to sort of factor that in and disclose that, and that starts to become transparent. But I will take a little bit of an exception when I was listening. I was able to see, but not participate in the earlier panels where there's the talk about a price on carbon. I don't think that's the most important policy here. I think the most important policy is what you can actually get done that will actually reduce emissions. And New York State is to be applauded. The fracking ban, getting rid of Law 97 in New York City. All of these things actually start to ratchet down emissions. And I would say banning single-use plastics is a really good example, because if you take that policy action, that's something you can accomplish. It means then that you're reducing the burden on municipalities, you're reducing the emissions factor of businesses that are operating, and that is those sorts of actions that you can take. And New York has such incredible leadership on these policies that when we modeled our climate targets, we were able to reduce our emissions much more significantly in the near term when we modeled New York State's policies into what we saw coming in the future. Because those are the policies that are going to have the greatest impact. And they're not like things that we could or might do in the future, but they're things that you are actually doing every day up in Albany. And so that we greatly appreciate and support that kind of leadership.
We'll put Senator Palumbo.
Thank you, Chairman. Thank you all for all your commitment to the community. As far as Mr. Frischberg, I think to follow up what Senator May was just talking about, and as far as reduction of emissions, one of the CLCPA, when we want to do 40 by 30, what do you think the feasibility is of actually 85 by 50? Because when I think about, and you even said banning of fracking, of course the wastewater is the most significant concern, but are we sacrificing pretty good for perfect? Where, for example, Indian Point shuts down, and now you have all these old oil-fired refineries providing power that in the short term it reduces emissions, but what about the long-term goals? I almost think like long-term capital projects in my mind, like what can we do to get there? We've got some okay incentives, some of them are expiring for, say, commercial solar. We have huge wind farm projects in my district. I'm out on the east end of Long Island. We have some real serious wind farm, however many gigawatts will be produced. So we're getting there, and we all agree that we need to get there. But I'm almost thinking that sometimes even banning commercial gas hookups, I know that's been knocked around. In the short term, is that smart? And that's why I don't really have an opinion either way. I'm just curious. So what your take would be on feasibility and long-term goals, because we've got now 8 years to get to 2030. And yeah, we've done some good reduction measures as far as overall emissions, but in the big picture, can we go much further?
I mean, the IPCC report that came out yesterday said we'll probably exceed 1.5 within the next decade. So one of the challenges is we've been long-terming this for so long that it's here now. And there's we have to be making some, if we want to stay in reality within 2 and the kind of stuff that's actually going to protect New York, we have to start being pretty absolute about it. And that's how we will get there. And I think we can get there. If you look at things like at every point in this process, the development of wind, the development of solar, what's happening in the EV market right now, it is always way, way ahead of what anybody predicted. That when it takes off, it just takes off. And, if we want to, what I've heard is the thing that's holding back the electrification market in buildings is really not the technology. It's not even the cost. It is the companies and the firms that are developing this that have a real, the market has to catch up. Because right now there is no way it makes sense to build new housing with a gas hookup. Absolutely no sense. Because you are building in 40 or 50 years of emissions, which we know are 100% going to be in excess of any reasonable climate target. And so the thing that you need to do in an existing home, and this is a place where real policy could come in and be extraordinarily helpful. If a furnace or gas furnace or a boiler goes out in my house, right? I call up somebody who's going to fix that, and I need heat and I need it done right away. If I go with something that's polluting and gas and not electrified, I've locked that supply in for a long time, or I'm going to have to throw out something that's perfectly good. But I need that heat right today. So if the thing that is going to hold me up is whether the person I call is ready to install the induction stove or the electric heater, or, most often is, am I going to require an electrical upgrade and fix my panel to also get an electric furnace or a heat pump? And that's the thing that will hold me back. And so I think from a policy perspective, we can do all those things. The technology is there, the workers can be trained, the supply chains can be there, but we need to start to kind of support some of those pain points, like providing a tax credit for panel upgrades if you're replacing a furnace with a heat pump, a gas furnace with a heat pump. Those are sorts of things that could happen that will help get us out of this long-termism thing that's sort of gotten us into what is a pretty untenable situation for the future.
And, and I like the comment, and I agree with the incentivizing. A lot of times we legislate by punishment, that we basically ban something, like, for example, something like we want everyone to have electric vehicles and say, we're going to tax the heck out of fossil fuels, and too bad, middle-class worker who needs to take his truck to work every day, you have to get hammered over the head. I like the incentive side. I like what you're saying, that provide tax incentives or even incentives for developers to throw out, to really move this market along quickly and get there. The technology's getting there with batteries and so forth. And just one last comment, more or less a comment than a question, and certainly feel free to respond. Out by me, we have innovative advanced septic systems. On Long Island, we drink from a sole source aquifer under our feet, and we have a huge nitrogen problem. And because you can't sewer Long Island, particularly some of those areas out east where I live. So you have septic tanks. Now these reduce the nitrogen in the effluent to almost zero, and we provided incentives to homeowners. If you have a new construction or 50% renovation, we would give subsidies. And that was a wonderful, and it's working. Are we going to do it one house at a time? Probably not, but we can, thinking along those lines, and I certainly would love to hear if you have any comments in that regard. I just think it would be accepted much more widely, and people would be more invigorated if we could provide state-funded incentives even. We just did this in my district last year with an affordable housing fund to help people buy homes on the east end of Long Island because they're so expensive. Those type of things. What do you think about feasibility and reality of that? Do you suggest that or not?
I think in a broad context, we need incentives. And clearly, like the growth we made on renewable energy has come because we've had incentives, tax credits at the federal level. We've had sort of mandates for purchasing renewable energy, renewable portfolio standards. Those have also driven a huge part of our progress. But I'm all for bans. Like at some level, you have to kind of create a level playing field and certain things, whether it's, I think, single-use plastics or whether it's, new gas hookups. There are just certain things that we know, let's just level the playing field and sort of, and be smart about the way we're going to build forward. But I think it always, so I'm all for banning things. I think though we kind of support that with incentives and mandates and things and job training programs and everything that makes the whole system work. It's not, you can't just pick one strategy or another or sort of say, oh, it's got to be this, we just need bans or we just need incentives.
I mean, that's kind of harsh language. I love bans. I'm all for bans. It's pretty funny. But I do agree. Maybe a carrot and stick type of a view of the world is the way to move forward. So I do certainly thank you all for your comments.
We ban lots of things in society when we think they're not good, right? We ban cigarettes for young people, and we ban, you name the things, right? That you probably appreciate a lot of bans in your life. We all appreciate them until there's some special interest behind them that says, no, we can't, but that is part of the package. I think it's inevitable, and it's part of the progress that we've made.
Well, I'm going to show the limitation. I'm not going to ban any conversation. I will show the limitation of it. I will say this, my friends, that one must think globally, but you have to act locally. And watch that. I'm headed somewhere, Kevin. We have to think globally, but you have to act locally. These three of these folk I'm honored to have in my district, and I invite you, Ivan, to move in. And you can't move in, Senator Palumbo, because if you do, you'll run against me and you'll win. So I can't have that happen. So don't move in. Stay where you are at Long Island. Although I'm coming out, I'm now taking part of Long Island in my district, so I'm migrating towards you, sir. I now have the 5 towns in my district, God willing, if everything lasts or whatever, the new proposed district. So I'm migrating myself towards you. Who knows what happens from there. We in the Rockaways, we've got our work cut out. because this is no longer a theoretical conversation. I have lived long enough to see the beach disappear and to see the changes in the local community. We really are the lower ninth ward of New York City. Whatever is going to happen in New York City is going to happen into this place first. So we've really got to figure this one and have this is why a partnership with Amalgamated Bank may make sense. Something, some bank that sees a future and looks at that the state has said that they're going to do some CRA stuff. I'm sorry, let me do it better. I forget I'm a senator and I'm just speaking. The state has said that they are now going to allow CRA credits for banking and financial systems. Under those conditions, a far-sighted bank like Amalgamated may see some use, some value in doing things in such a community. I was about to plant trees. We're gonna plant 100,000 trees in my entire district. I will reach out to you to see if any of this catches what you're saying. We're going to work on this resiliency business, but I will yield to Dr. Williams, and then I will allow Kevin and Sandy to have any last words that they want to say. Dr. Williams.
Thank you, Senator. I just want to respond to a couple of things. And one of them is that, when we say, because I also live in the Rockaways, Regional Ready Rockaway is in the Rockaways. And when we say that the Rockaways is still not prepared, that's true to a certain extent, but it will never be prepared unless we find changes legislatively from all three disciplines of government. And if you can't protect the waterfronts, which consumes the community, and where we get the greatest impact of devastation, like we saw with Hurricane Sandy, then you're going to continue to have the conversation about us not being prepared. In addition to that, I think that is critically important that while we talk about fossil fuels, we talk about the things that contribute to climate change and global warming, we also have to recognize the void of the things that don't allow us to protect our coastal communities, where the economy, the banking, and everything else that's been in this discussion today becomes prevalent. And that's just the reality. And I think it was just important to be able to express that, because I think it's critical. And I would also go on to say that advocacy organizations like Regional Ready Rockaway and its partners have introduced recommendations on all three levels of government on how to improve the protection, not only of our community and the people that live in it, but the changes that we're starting to see as a result of the revitalization of the Rockaways. Thank you for the opportunity to speak.
Thank you. I'll let Ms. Pope go next. Ms. Pope, if you have any last words, you could take a minute, go for it.
Okay, good, thank you. I just wanted to commend Mr. Frischberg about the variety of ideas. Not one solution will make an impact on climate change and global warming. One organization I saw was making a line of clothing out of metal cans. So that process has to go through whatever process it goes through, but it's a start. And I think if we kind of introduce these new ideas to our young people, because I think that global warming is a boring project, a boring subject to our young people. They believe one day they can go out with sandals on and the next day they got to wear a coat. So we need to energize our young people and make global warming exciting for them to participate, for them to be a partner of it, so that they can help see the importance of their position in making a difference in this climate change. Because as I said earlier, they're the recipients. We talk about 20 years down the road, 30 years down the road, but they're the recipients of what's going to be happening. So they need to know what part they can play to participate in lessening the impact of climate change and global warming. So I'm doing my little part. My System for Clean Water has been in existence since 2016. We not only focused on clean water, but we focused on the impact of beach cleaning and educating on television and sorts. But most important, we have to create several different ideas for young people to be involved so that they can feel that they're helping to make a change in this climate warming and global warming and climate change.
Thank you very much, Mr. Alexander, Kevin Alexander, with the penultimate word here.
Thank you. Thank you for the opportunity. I think this has been a great conversation. The one thing I always think about is when we talk about regulation and policy changes, what's the unintended consequences of doing that at the local level? And Senator, you were alluding to that as well. And the concern that we have as a coastal community that serves as a barrier to the rest of New York is what will these impacts have? And also, what are the opportunities by having a shift from fossil fuels to other alternative energies? Or will there be opportunities for investment? And as Ms. Pope said, for educating our youth and getting more people aware of why this is so important to them and how it will impact them. So I think it's a combination at the state level with the elected officials such as yourself, persons like Amalgamated Bank and Mr. Frisberg that's looking at policy in different areas, but also at the local level. I think it's a multi-level conversation that has to continue, because my thing is, as a grassroots organization, let's say, my boots are on the ground, and when something is changed, I hear it. There might not be initial input, but when it does change, we feel it. And so what we try and do is minimize that by doing things like education, participation, and making certain that we engage the community the best we can. So I'll leave it at that. And this is a great start to a continuing conversation. Thank you.
Well, the conversation absolutely must continue until we save the planet. And it is saved by one action at a time. What we do, what we people do, is very important. I want to thank my staff for doing a yeoman's job of putting this panel together, of finding everybody who's won from people who won Nobel Peace Prizes to the first ever people at the Department of Financial Services, to just getting an incredible panel together. And of course, saving the best for last, my Rockaway panel, and joined, of course, by a person who fit right well at the local level, from the Amalgamated Bank. What else? This is where labor fits in. This is where we are. After all is said and done, these theoretical things have to have a real world implications. So I want to thank everyone who has been here. Our next steps, of course, are what we are going to do. I've already alluded to some of them. We're going to do some massive tree planting and working on our resiliency, which means that I will have to work with Ready Rockaways, which means I will have to work with Sister Girls for Clean Water. And of course, I will have to work with the Rockaway Development and Revitalization Corporation. Yes, that's a plug and an advertisement for those who did not know. But we may make new friends. The Amalgamated Bank may be a new friend to us. And we therefore will have to be good friends to them too. Having said all of those things, there's so much more that needs to be said on this issue, but it need not be said today. We are going to struggle as a struggle of a lifetime, and I encourage all of us to enjoy the struggle, including today. Having said that, this roundtable, this hearing, I stand corrected, this hearing is officially closed.
Thank you so
I
much,
hope to see
Senator.
you all.
Thank you.